Please be advised that the information presented herein is for educational purposes only. It is strongly recommended that listeners should seek guidance from qualified paid professionals of their choosing before acting upon any information or materials discussed. Hey everyone, welcome again to Real Estate News Unpacked. I'm your co-host Marcel, your mortgage money guy, alongside Ronald, your 5-star Michelin design. All things multiplex is what he brings you here at Real Estate News Unpacked. We basically take the headlines, the main headlines for the week, and we simplify them for your listening pleasure. So what we have today or this week, the main thing is the Bank of Canada, their decisions to hold steady and why that matters and why that may have been a decision that came too soon in the light of what's happening in the US and Trump. Also, as well, what we've got is the DCs, continued discussions on DCs. This is a real game changer for smaller missing middle projects. How those are changing across Canada. We're going to bring you some news from some municipalities are really stepping up their DC game. All of that on this edition of Real Estate News Unpacked. Let's go.
Yeah, this month has been an awesome month. We're now 10 episodes in deep, and this is great. So, for the listeners of this podcast, please remember to like, subscribe, and leave us a comment. We'd be really happy to even elaborate on some of those comments with a video. So, hopefully, we'll see some comments in that box right below. Okay, awesome. So, Marcel, I think we're jumping into some really exciting topics today, right?
Yeah, let's go. Let's start off with the Bank of Canada and what is happening with them. So as as you probably heard, if you haven't heard, the Bank of Canada has held steady at 2.75 as the economy shows resilience in the face of tariffs. And I kind of laugh. You're chuckling there, Ron, as well.
Resilience. That's like that's such a false word to use in this case.
Yeah, like I don't really know what that means. But I think what's important here is we're hearing some feedback from industry that's saying, hey, no, Bank of Canada, that wasn't the right decision. This was something you should have dropped. Actually, there should have been a cut. So we can look at, actually, we have a slide here from this is the Mortgage Brokers Association, and it talks about, while we certainly understand the Bank of Canada's position to take a cautionary approach, we fear holding rates steady now will do little to encourage confidence in the housing market. So the president of CMBA Ontario, a rate cut would have been a promising signal to both prospective owners and investors. Investors got a shout out. Not too sure how they arrived there. As well as easing costs for those with existing homes and variable rate mortgages. So this is the sentiment and the position of the industry and what they felt should have happened with this rate change. Now, what's important with this rate change is there was a monetary policy report that was released with this in July. And in that report, what they talk about is the scenarios, and this is all premised around tariffs, right? Like the tariffs are really driving, the tariff wars are really driving the decision here. And they give 3 scenarios within this report that basically hold their assumptions for why they made the decision. So
now, what are those 3 scenarios? Like high level, what are those 3 scenarios?
Yeah, so the 3 scenarios are basically the current state, right? So and this was as of July 30th, the current state of where we're at, the escalated state. So let's just say tariffs went up, and then the de-escalated state, right? So it's brought down. So let's look at these and really kind of unpack like what these mean, and most importantly, like really what these mean for interest rates, and where interest rates would land with the various scenarios. So the first scenario here, current status, once again, this is as of July 30th. I keep or as of July 27th. So status as per usual, what we have in place right now, you can see there with the United States, the kind of that 13% range, and the retaliatory tariffs from Canada. Really, that is kind of the scenario right now. Really high uncertainty. So growth is restrained, high levels of uncertainty, inflation close to 2%. What that means for rates is we hold steady.
Okay.
Right. And we wait for like clear signals that the tariffs are handled, and there's not going to be any there's not going to be any issues regarding that.
That's
right. So not too sure how realistic that is. That's a little bit, in my opinion, a bit of a false assumption, because like nothing remains steady in the universe, right?
Yeah,
like everything is constant. So let's look at the de-escalated scenario now. So in this case, it would be a reduction in the tariffs, right? So in this case, they're looking at a rate of 10% with U.S. tariffs. So in this case, what happens is, with trade policies and output productivity recoveries, imported cost pressures unwind, right? So in this scenario, the Bank of Canada has room to pause for longer and then even potentially cut rates, right? So this is the scenario everyone wishes for. This is kind of, back to as close to normal as we were. And these would be kind of like as soon as late 2025, early 2026, right? If the inflation stays kind of at target or below target, right? So this is the hopeful scenario. What do you think the likeliness of this is, Ron?
I think this is a non-starter here. This is not possible given the volatility we have been seeing coming. All the global instability with all this tariff talks. We know, like, we're dealing with an administration, right, across the border that is pro-tariffs. So at some point, like, all of the floodgates are going to open and basically tariffs are going to start pouring in. And whether we start feeling that in the near term or short term, that's left to be determined. But again, like, I'd like to see what is the next scenario. I mean, this to me is quite interesting.
Yeah, so the escalated scenario, which is the third scenario noted in this in the July Bank of Canada monetary report, really is the scenario where the United States like substantially increased its tariffs on most countries, right? So the U.S. Weighted average tariff rate on all countries is 28%.
Yeah.
So in this, this is
that's a tax times 2.
Yeah, this is a real kick in the teeth. So what happens here is, sharp headwinds on growth and investment really, could cause inflation to get out of control. And this is like cost push, like, costs kind of go up, right? Like spike rapidly. And then what happens is demand will soften. So essentially, to explain that in regular kind of layman's terms, is if businesses face tougher conditions and higher costs at the same time, they may raise prices and then make everyone worry that inflation will stay high, despite the fact that people are actually buying less, right? So there's this whole kind of mind sentiment shift that will really happen as a result of this, and then what will happen from a rate perspective, because why does this matter? What does this mean for rates? Is to guard against kind of like this inflation shock, right? The Bank of Canada could be compelled to raise rates further, right? Above the 2.75, at least until trade policy kind of uncertainties reside or subside, right? So this is the scenario that happens if things escalate.
Wow.
Now, all this to say, and as a result, and this is why when I saw the industry stuff and the industry news and some of these industry news that were saying, this wasn't the right decision.
Yeah.
I think, they weren't, what I didn't see from them is they didn't peel the onion enough. They wanted it to self-serve, which is great for, industry professionals and, more people start buying or whatever. And, but we're facing a bigger problem here on a more macro scale that's beyond, people just, buying homes and having better interest rates right now, right? So we really have to be strategic about our next move, and what happens. But all this to say is the next moves really will hinge on, what happens with this trade path kind of as it materializes. So where do you see this going, Ron?
Well, this escalated scenario is quite scary because the market as it stands today, I think buyers' sentiment is escalating, or from the standpoint of fear. Their fear is escalated already. And if we were to actually get into a scenario like this is going to lead to further escalation of fear, which is going to lead to a significant reduction in activity, economic activity.
Exactly.
Right?
Yeah.
And to your point, buyers are going to stop buying, right? So essentially, inflation, what does that mean? There's less people buying, so prices should come down, meaning inflation should go down. But it's going to be pushed up by price itself, things becoming more costly because now
things becoming more costly. Exactly. Yeah.
So this is kind of a rock.
Remember, businesses get hit, right?
Yeah.
Like I said, businesses get hit, tougher conditions. Oh my gosh, it's costing me more.
Yeah.
Okay, I got to raise my price. Right?
So
and now,
so what's going to happen?
And now everyone stops buying when the price goes up, right?
So this is what that job is, such a challenging job, and as much as we want to hope that there's a crystal ball somewhere hidden in that big building, right, that they can somehow read the future, I think the news headlines, in the last few hours, kind of really shows that there's no crystal ball. There's a lot of uncertainty, right?
Yeah, let's talk about that, right? Because look what just happened as of today. This is August 1st, 2025, as of today.
Oh,
wow.
35.
Trump, 35% on Canada. So there you have it. We could be in that escalation scenario sooner. This is literally days, a couple days after that decision was made. So this is kind of where we're at. And when I read through that article, Ron, and Carney's response, Carney didn't really say much about retaliatory efforts or what. He really kind of honed in on hey man, I'm disappointed with this decision. We're gonna continue to work on our fentanyl border issues, but really what he leaned into, the comments didn't seem retaliatory in nature. What he leaned into was okay, Canadians, and I've got it here, Canadians will be our best customer, creating more well-paying careers at home as we strengthen and diversify our trading partnerships throughout the world.
Wow.
So this is a further lean in to unlocking trade and activity within Canada.
That's good.
Which, we really should have been on, but it took a real kick in the teeth to get us moving. I think that will be the learning if we step back and look at this, 10, 15 years from now, right? We'll be like, oh, wow, why weren't we doing that already, right?
Yeah.
But this that last piece is really where it starts to get interesting, right? Our trading partnerships throughout the world. And, this is something, once again, we've been resting on our laurels on just relying on the United States, for most of our trade. And so now, we got to turn to Europe and other allies too.
And I really feel, to some degree, I want to think this is really a steady hand steady-handed leader that is running these negotiations, and rather than sort of spilling all their beans and really, and I'm talking about Prime Minister, right? Prime Minister
Yeah.
Mark Carney, like he's really not revealing his real intention here. But I think to some degree, and I think most of the listeners would agree, there's some impetus here to align with Europe, right? And to kind of build out that relationship that really hasn't been what it should be or could be, right?
Yeah.
It's because the US has really proven that they're unreliable. This is kind of the statement coming from everyone.
Yeah. Yeah. They're being troublemakers right now and stirring the pot, right? Which once again I've got some new thinking on, like if we look at this, it's tough right now being in the pot, right? We're in the pot, we're being stirred, right? This is tough. This is a tough
You're being poached right now. You're poached.
We're poached, right? We're about to be eaten.
Yeah.
Right? But if we look at this 10, 15 years from now in a case study, what does that look like?
Oh,
right?
It's going to be great for the economy of Canada.
Yeah, it'll look like, wow, there was the catalyst.
Yeah.
That was the catalyst that kind of gave, you got the kick in the teeth, and you spurred on innovation, you spurred on interprovincial trade, you spurred on, better policy. I'm a big proponent of entrepreneurs, like reinvestment in entrepreneurs, tax breaks and incentives, like all of these things need to be worked on. And of course, the big one for us while we're here, housing, right?
Yeah, that's right.
I think we've gotten, and we're gonna talk more about housing.
Yeah,
I think
for sure.
why don't we jump? That's a good segue to jump right into something you've got ready in the hopper there with this new housing this new housing plan, this ambitious housing plan that Carney has, and we're not going to talk about the actual plan, but just kind of in that direction, right? I think is the key thing that we're looking at here. So like, I think housing, Canada, for the first time in a long time, I think is getting it right. I think we've got some good policy around housing. We're heading in the right direction. We're getting that right. Like in that direction. However, I do reiterate, we still need more work on the side where it comes to taxes, investment in innovation, investment in entrepreneurs. Those things, that's a little outside of this topic, but those things need to be worked on if we're going to see, a bright future ahead for Canada. But let's jump into this run.
Well, to that point, I think maybe I'll preface this by saying the stars are aligning, right? The stars are aligning, and we're starting to see Canada become stronger, or we will see Canada become stronger internal trading partners, right? The provinces. Now you're seeing the provinces all sitting around, all the premiers sitting around a round table and looking at tearing down barriers than building barriers, right? And this is going to be extremely powerful because Canada is a big nation. Canada is one of the G7 nations, right? And this is strong economies, and so I really like what I'm seeing with regards to that. And of course, we know housing is a huge driver of economic growth, and we can see here Mark Carney's Liberal unveiled Canada's most ambitious housing plan. While I'm not going to dive into the housing plan specifically, I want to talk about some aspect of the housing plan, and more particularly this whole idea of DCs. I think we have talked enough about DCs on this podcast here to really people understand the challenges with development charges. And
let's first of all, this is unpacked. So what are DCs? And why do they matter?
So DCs, development charges, is essentially a fee that is applied to new development in any city, whether it be a new build, institutional building, commercial building, industrial building, or residential. Any of those type of construction, really development charges are applied so that new development will fund the growth of the infrastructure as well, right?
Perfect.
So new growth funds growth. And that's the whole idea behind development charges. Now, development charges have really gone out of control. And we'll talk more about this as we go on through this. But really, this is kind of an idea that I recently thought, because we're living in a tariff environment today, right, Marcel? We're in a tariff environment. And this is something that I recognize, is that for years, developers have essentially been tariffed by municipalities on developments.
Ooh.
Right? Hey, listen, we can't say this softly, man. This is the reality, right? What are tariffs? What are tariffs designed to do, right? To deter trade, right? And it almost seems like maybe unintentional or unintended consequence of development charges, quote unquote tariffs, is essentially it's basically discouraging development, right?
No, 100%, 100%. Yeah.
So,
and you know, if you combine that with all the other things that make development hard, you know, one of the, you know, like I talk about, you know, with my story, one of the reasons I put my pen down on development was between DCs and entitlements. Like I don't even have to continue, right? Like full stop. Right.
It's
like, you know, you're in the middle scale, you know, like, and you know, like you just like your probability of success just is eroded. So
it's eroded. It's eroded. And many people and many industry organizations, stakeholders, for example, build. That's, you know, they have certainly advocated for these type of changes, and we're starting to see more and more of it. And here's one of the key words I want to talk about. While tariff is a key word in this current economy and environment we're living in, geopolitical and of course economic environment, here's another key word: alignment, right? And we're starting to see alignment across nations. Well, new bridges being built, right? Where walls are going up, we're turning our backs and we're starting to build bridges in another direction. And we're starting to see that on a national level, on a provincial level, on a municipal level, city to city. And I want to kind of just highlight that. And you can see here that basically one of the core aspects about Carney's housing plan, which is to build Canada homes plan, is that we're starting to see that there is going to be a municipal or some sort of provisions or policy that will eventually come into play that will cut municipal development charges in half. What would that have done for any of your developments? Like, I mean, in general, you know, we're going to talk about development, but what would that do just even in terms of motivation to go ahead and do developments?
Yeah, absolutely. I mean, that's a game changer. I mean, especially on the small scale, like the DCs are on the smaller scale stuff. literally part of your profit margin. That's literally like that. That literally helps your project to pencil.
Absolutely.
Or less, right?
And
this is interesting because it's, you know, they it's a little bit vague here. You know, it's for multi-unit residential housing. So, you know, to anyone watching this and you're wondering, you know, what should I be doing? Well, there's the answer: multi-unit residential housing, and and follow the bag, right? You always got to follow the money.
Follow the money.
While this is vague, I mean, this, to me, I look at this and that just screams multi-unit residential housing, kind of 5 units plus, right? Where CMHC is playing on that refinance, right, with MLI and the different programs. That's what I'm seeing with that, right?
And I think that will be a great alignment. It would be a real shame if they missed that mark and somehow increased this proposed 50% cut on DCs to units that are, you know, maybe let's say 20 units and above or 60 units and above. I think they.
I see what you mean. So like larger scale multi-residential.
Exactly.
Right? Like you have to hit a certain threshold, whatever it is.
Yeah, the threshold should start from 5 because that is where it is. Right. We are seeing, you know, right now, and I think you mentioned this in a previous recording, like CMHC is now insuring more mortgages, rental units, right, than first-time home buyers. So who is
mortgages? They're building a war chest. It's like,
well, hey, this is wartime. This is wartime.
They will be the largest like unofficial owner of rental units in the country.
I see that. I
Right.
mean, that's pretty impressive. So the Canada is building again, but not only Canada, right? Canada is not the only Canada. When I say Canada, I mean the feds, right? The federal government is not the only people that are focused on providing housing and basically subsidizing or incentivizing building development, because this is a huge driver in every nation in the as particularly Canada. And we're starting to see this on a provincial level. So again, it's coming from the top, right? So federally, Mark Carney and his team, they're pulling together DCs. They're saying, look, we're going to support DCs. We understand the importance of cutting these DCs. And then in addition to that, we can see here on a provincial level, provincially, right? The Doug Ford and his team is now saying, look, we are going to implement policies as well. So we have talked about this on this recording before, where it is we looked at Bill 17 and some of the benefits of Bill 17, particularly as it relates to development charges. Now, there is a number of things that are sort of touched on in Bill 17, right? So there's Building Code Act that's changed, there's Transit Acts that are changed, there's Environmental Act, but particularly this Development Charges Act. This is a huge hurdle that most developers are coming up to, and they're just basically turning back and saying, like, we can't get our legs over that. That hurdle is too much. It's too much for us to get over.
So what's happening there?
Yeah, so essentially what we're looking at is we're starting to see that in through Bill 17, right, the provincial government has opted to encourage, right, I'll say encourage, municipalities to freeze, defer, and remove interest from development charge payments. And for those of you might be wondering, what does all this mean? What is a development charge freeze? What is a development charge deferral? So let's kind of talk real briefly about two of those things, right? So a development deferral, so essentially when you apply for a development charge, or not apply, when you apply for a building permit to construct a building in any city throughout Ontario, you essentially will be charged a development charge, right? That's the fee you'll have to pay for developing. Now,
And how's that calculated?
that is calculated, or that is basically determined based on a rate that the city established. So they have their studies that they do. They determine how much infrastructure is needed and how does your particular development is going to impact that infrastructure. And then they develop.
And that's on a per unit basis.
That's on a per unit basis, depending if it's rental or non-rental or industrial and so forth. Now,
And it varies across bedrooms.
it varies across various type of bedrooms. That's right. So whether it be studios, 1 bedrooms, 2 bedrooms, and so forth, all of these are variables that they use to calculate this. The finance department usually takes care of that. Now, why is this important? This is really important because those development charges are actually, they are determined at the time that you apply for the building permit, and then in the past they had to be paid out at the time the building permit was issued, unless you actually applied for a deferral. So you would have an agreement with the city to defer those payments till a later date, and then they would apply an interest rate to that payment, right? And you would pay the interest over that period of time until you actually, now the building would not reach occupancy until, or you wouldn't be established or got your occupancy permit until you get that money paid out. Now, with this in mind, it's very important to note that this deferral is now going to be essentially pushed out. So where it is you had to essentially pay at the time permits were issued, now you have to pay this money at the time occupancy. So this really pushes out, defers that project out, which gives you more developers, more ability or cash flow to build the project, right?
Yeah. So that's the key word there, right? The cash flow, right? So before, that is likely, for all intents and purposes, coming out of your pocket.
Yeah.
Right? Because you wouldn't have gotten your first draw yet. Once you have your permits, right? You wouldn't have gotten much done yet. So likely your first draw, would be some time away. So that money is coming out of your pocket. It's a cash flow issue.
It's coming out. That money is coming out of pocket. Now, in addition to that, there's a freeze. So what is a freeze? So we just talked about the studies that the city do every year to determine what is the rate they should apply to various type of units that are being built: 1 bedrooms, 2 bedrooms, industrial, commercial, institutional, residential. Like, how are they actually, what rate are we applying per unit? You know, in the city of Toronto, it could be up to, if it's a condo, it can be up to, or a single family home, it can be up to 130. It's listed on their website, right? For 120,000 to build a new home. That's a lot, right? It's a lot. This is no joke money, right? This is
between DCs and HST,
Yeah.
right? Like,
oh yeah, between those two, that's roughly
bye-bye.
that's like 35% of your basically your investment there, right? And what it is they have done now is essentially say, look, at the time that the city decides, so let's say January 2025, January 1st, 2025, the city decide that they're going to say they're $150,000 for a single family home. You applied for a permit to build this in 2025. So that's the rate that was established for your project. But you never build the project until 2027. 2 years have passed. They have revised their DC charges. So now the charges have increased to, let's say, $200,000 over that 2-year period, right? So you're in 2027 now, you want to build. The city actually has the ability to upgrade your DCs and say, look,
Yeah, you don't get grandfathered.
you don't get grandfathered in. You get to pay that new amount, right? So the surcharge, right? Now, so that's something that through Bill 17, based on my understanding, this is going to be removed. Like they're saying, like the freeze have to be the agreement that you have for DCs that stays. I guess they may put some specific regulations in there as to what the mechanism is behind that. But essentially, they can't change that and have you pay more, I guess, unwarranted, right?
Right.
So this is actually extremely important to development because this has such huge impact. And why I think this is important, because many people that are doing development throughout Ontario, like DCs is a question that come up all the time. And we're starting to see alignment. We talk about alignment. Alignment is huge because some of the big 3 cities that have major development charges have made some significant steps, right, Marcel? So kind of bringing this home.
Yeah. I'm seeing that. So we've got Toronto. Obviously, we've talked about that on past pods.
Exactly.
Who else is in the lineup here, Ron?
Yeah,
for some
well,
changes.
even before I talk about who else, I want to just point this out here. I mean, you can see that Toronto is like in a 2-bedroom home. Essentially, what is we have seen, or what is we will see, is that there was an increase between 2020. There was an increase in 2 bedrooms, from 1 bedroom and 2 bedroom, to roughly 45% year over year between August 2023 and 2024. This is 1 year. 40. This is almost 50%. So let's think about this. If the DCs were 100,000, to keep numbers nice and round, this is roughly 50% increase year over year, right? So you're talking about almost an additional $42,000 in 1 year increase. Like, how is that justified, right? As I mentioned, this is a tariff. This is designed almost to deter development, at least maybe unintentionally, but this is the case.
Yeah.
Right.
And I mean, even look at the tenfold going back further. It talks about DCs on unit types increase from 5,000 and 8,000 respectively from 2009 to 52 and 80,000. That's like tenfold, right? Like,
man,
so
like how
this is it's been a runaway train.
It's
right?
a runaway train.
This DC,
and
this
you know
DC
what?
thing.
We just continue to see this, but again, there's alignment. There is a real impetus to actually see housing built. And we're starting to see more and more municipalities are starting to basically slash. So we saw on a federal level, we see 50%.
Mississauga.
Now we're seeing Mississauga saying, look, you know what? We are going to do up to 100,000. Okay, not 100,000.
100%.
100%. 100% Mississauga is going to cut their DCs by 100% up to,
Up to.
right? Up to. So I want to say up to because it depends on the size of the units. Now,
Right.
I think we were talking about this before, but we probably should do a nice little chart to really show the listeners how this works out depending on the city that you're working in and the type of unit you're building or the scale of the development, how DCs are going to
That would be
impact. Is it
very
going to
interest-
win?
Yeah.
Right?
That would be very interesting, especially, as people are really selecting where their investment, place is, right? So to really understand, like, who's really being forward looking with this whole DC thing, and the unlock, that I think that'd be super interesting. Yeah. Yeah.
Well, it goes without make no mistake. I mean, like this thing is saying, like basically development charges account for 10% of the final cost of construction in Mississauga, with 25% of the GTA home prices stemming from these fees, these taxes and other charges. Like this is a huge cost to development. 25%. If you build $1 million home, $250,000. That's just soft cost, right? And we're not talking about all the other things that still has to be done, interest on your payments and so forth. This is very costly. But what I really want to point to here, Marcel, is basically look at the plummet, right? So you can see the plummet, right? So development charges from residential apartments have now plummeted from 38,316 per unit to 19. Right, 19,158 per unit.
It's going in the right direction.
It's going in the right direction, and we're starting to see more
reversal.
and more of that.
Yeah.
And I'm
That half, near half there is almost kind of back to normality where maybe it should be, right?
I know. So let's not start giving gold medals and trophies to these cities, right? They're just bringing things back to where they should be in reality. Right, we're just removing the
No
tower.
one's getting a gold star just yet. Maybe City of Toronto, are a close contender. But
That's right.
Who else do we have? Who else is in this race?
Yeah, absolutely. So we do have other cities that are making these moves, and one in particular is Vaughan. So the Honorable
Vaughan.
Stephen Del Duca, mayor, basically dramatically dropped development charges some time ago there, like a few months ago. And now what we're actually seeing is that particularly like this is really important. Like developers have been lobbying for this for quite some time, right? And you can see here that now Vaughan has actually reduced their development charges, which was actually basically it was a whopping 229%. Like this is
Once again, runaway train. Now you're kind of getting back to some sort of normality. Still high though, right?
Yeah, absolutely. Still high. I mean,
Still high.
but again, this is essentially, they have now cut their DCs in half, 50%, right? So I say you're looking at where you would have placed like $100,000 on a semi or so forth. Now that charge has been cut to roughly around $50,000. This is significant. This is, I want to say money in the pocket of the developer, but more so, this is another home that can be built. So if you're looking at DCs as just an input, right? If you had to pay $100,000 on a semi-detached home, right? Now you can build 2 semi-detached homes because that fee can now spread across multiple homes. And I think that's the effect that they're essentially looking for, so that they can create more homes now. So rather than saying we plan a development of just 10 homes, we can plan development of, all things remain equal, right, of 20 homes. You know what I'm saying? Because now we're now splitting that DC charges there, right?
Yeah.
And I think
the reality is, just between these three cities here, if I'm thinking about it, Toronto, for all intents and purposes, would be your best bet for anything larger, 5+ units. I wouldn't really see that as an option in Vaughan. Vaughan is going to be more your singles and your semis, maybe your towns. Just based on the scale and the way the cities kind of develop. Mississauga is interesting. I think Mississauga, there's some very natural duplexes and triplexes in some of the existing stock there that could get unlocked now. So, but
No.
I think your biggest bang is if I'm gonna award a gold star, I think I
Yeah.
would be awarding that to City of Toronto and the based on the type of stock that it has, um, you know fantastic for this kind of sixplex.
No, 100%. I would definitely award some encouragement stars, so that they keep on. When you go to those little junior K's, SK type graduations, everyone gets a star. And look, this is for motivation. It's to keep everyone encouraged, right?
The purple participation.
A participation. That's what it's called, a purple participation. Right? And you put that patch right on your shoulder and wear it proudly. Because, honestly speaking, this is where we need to be going. We're headed in the right direction. We hope to see more cities actually doing more of this type of work, really addressing their policies. And maybe if I maybe stutter, I'll say it again. Federally, when Mark Carney's plan comes into effect, 50% is going to be across Canada, right? When the regulations are ratified for Bill 17, this would mean in Ontario, we are deferred, we are frozen, there's no more DCs. And when you look at cities like our great city of Toronto, the largest, most populous city, right? Am I correct when I say that, Marcel?
That's correct. That's correct, sir.
When we talk about Toronto has already gone ahead and they have said, you know what? We are going to embrace the change. We are going to be Canada strong and we are going to remove DCs on up to 6 dwelling units because this is the type of housing that we want to see more of. We're going to see this missing middle typology really be incentivize developers to do these. So again, I make no mistake when I say this is moving in that direction. At some point when the pendulum, we talked about the pendulum, when the pendulum has swung in the direction where it's becoming unrealistic to waive these type of fees, then they have the right to kind of put the plug. But for now, we got to remove the plug and get development flowing again.
Yeah. So for missing middle developers, investors, homeowners, I gave the example of hey man, 5 units, right? Live in one, rent out 4, that's you're rent free, right? I gave that example, right? Of in one of our last pods. This is the current opportunity. This is why all this matters, right?
That's right.
We've got a situation in the economy. So from a macro level, we've got a situation in the economy right now where people are frozen, they're uncertain, fear is high, right? So this is where you have to dig deep on your economic fundamentals. Not like exuberism, but it's you lean into the economic fundamentals, right? You look at where the DCs are most favorable. You look at what municipalities are getting that bag, that half bag, right? Yeah. What's the half, Ronald?
Housing Accelerator Fund. Half.
The Housing Accelerator Fund. You look at who is really getting that money, where that money is flowing, right? And this is how you have to be making your decision on where you're going to invest, where you're going to develop.
Exactly.
Right? Those will be the municipalities that are supporting housing, and those will be the municipalities that are supporting you, quite frankly, as the developer. So this is why we bring this information to you. Those are the important points. Why all this matters from a macro perspective, right? And then right down into the weeds with DC rates, right? As a small part of Bill 17, and where they're being affected in the respective municipalities. Remember, you don't develop in Canada, you develop in a locale, right?
Exactly.
Somewhere, in a city that's very local, and then even more specific in a place like Toronto, in a neighborhood, right? You focus in. So this is why this is important, and this is why we break it down in this manner. Ron, final thoughts?
Yeah,
take us
man.
out.
Final thoughts is like I couldn't wrap it up any better, my friend. Absolutely. If you're looking for this type of product, anything missing middle, this is where the opportunity exists today. Follow the money. The DC money bag in particular, cities are slashing it, money is falling out from the bottom. So, right now we need to make sure that you optimize. If you're an investor, if you're a builder, if you're a developer, if you're a contractor, you should be looking at these communities because these communities are pro-housing and they're really looking at how they can provide a solution to the housing crisis. And again, the various governments are providing funding to support and supplement these shortfalls. So this does not mean you're going to have potholes in your streets. This just means that the city is not collecting that from developers and, as an extension, the buyers. They're now collecting that infrastructure funding for directly from federal and provincial governments. So we're not going to be now looking at infrastructure that's being under maintained or deferred maintenance. It's going to be maintained. It's just not going to be in the short term at the cost of new development. So hopefully that makes sense. Right.
Yeah, absolutely. Great take, great summary. Ron, take us away here.
Yeah, absolutely.
Another great session.
Yeah, this is great. I really appreciate you guys taking the time to listen in to this recording of Real Estate News Unpacked. I'm your co-host Ronald, your 5-star Michelin multiplex designer, and I'm here with my co-host Marcel, our mortgage money guy, all things money lending. We are happy to do these recordings. We'd like to ask you guys to like and subscribe to this recording and leave us a comment. We'd be happy to make a recording on those type of comments. But we'll see you guys till next week.
See ya.